Good afternoon, everybody. Buenos tardes, señores y señoritas. It's Tony from Red Pill Quants. How you doing? Hope you're doing well. Here today to talk about everyone's favorite stock, at least for the last few weeks, which is Tesla. Mike and I have been getting tons of emails about, oh my God, I missed it. How do I play it with options? And in this video, I'm going to go through three different scenarios on Tesla: the bullish case, the bearish case, and the professional trade, and give you my perspective on how I would do all three of those. And I will leave it for you to decide which side of the fence you want to play on. In case you've been living in a cave and are not aware of what's going on in Tesla, you can see it's pretty much so been exploding higher for the last couple of weeks. It's been up from, beginning of last week, it opened at 565, and it essentially almost doubled. On Tuesday, it hit a high of 968.99 intraday, and it's been all over the map. It was up more than 10% Monday. It gapped up Tuesday and then ran up another 13, 14%. Gapped down yesterday, and then today it was up again almost 10% and closed down 6 or 7% off the highs. Excuse me. So, if you are bullish, the first thing you need to pay attention to is the implied volatility. And let's zoom out a bit and look at what's been going on here. So you will see the implied volatility in Tesla is currently running at right around 100%. Yes, I did say that correctly, 100%. It's peaked at around 120% on Tuesday when it shot up to 968.99, and now it's back down to only 100%. So the first thing we need to pay attention to here is typically when stocks shoot higher, the implied volatility does not spike. It tends to fall. In this case, the implied volatility shot through the roof because no one really knows where this is going. And if you're in the business of selling options, you need to cover your ass. And the only way you can do that is to crank up the implied volatility, which is exactly what happened. We can see last week the implied volatility was around 60%, which if we look at the Z-score, that's about normal for Tesla. I didn't say that wrong. 60% is pretty much so the normal for Tesla as far as implied volatility goes. Now, because the implied volatility is so high, it makes this very difficult to trade. We can see that since the price has come down, the implied volatility has also come down, which does not typically happen. Typically, when stocks sell off, the implied volatility shoots up. Like if we look at SPY and see what happened the last couple of weeks, you can see we had a sell-off, the implied volatility shot through the roof, and then it came back down as the market made all-time highs today at 334.19. So the important thing here is market up, implied volatility down. In Tesla, that is not the case because nobody knows where this cowboy is headed. So let's look at some scenarios So let's begin by looking at the bullish trade. And before I go into the way I would play it, let's look at the way not to play it, or the dum-dum trade. The dum-dum trade would be to buy a deep out-of-the-money call with the hope that it's going to explode higher if Tesla explodes higher. That could happen if Tesla does explode higher, but what if it slowly grinds higher, which is probably the more typical case going forward? Let's look at what would happen if we go out to May. We want to give ourselves some time for Tesla to explode higher. And let's look at the 1000 call, which is quite a bit out of the money. And with an implied volatility of 82.49%. My God, that's insanely high. The midpoint on this option is $56.35. So the May 1000 call is currently trading for $56.35. Now, why this is the dum-dum trade is what is likely to happen in the very near future is the implied volatility is probably going to drop quite a bit. So if it's at 82.49% and our option is $56.35, what does that do to the options price? And we can find that very easily in Thinkorswim by going to the layout and selecting Theo Price Mark, which is what I have here, and then clicking over here. So let's say the implied volatility drops 20 points back down to, let's say 62%. So we go minus 20. And we can see what happens is our 1000 call goes from a value of $56.35 to $29.83. Ouch. That's without the stock price moving at all. So the instant the implied volatility drops back down, this trade is pretty much so already 50% in the garbage can. Now let's look at what happens if the stock also moves down 50 points. If we go back up here and take this down 50 points, we can see our option is now worth $19.37. So we've lost roughly 60% of our trade by the stock only moving 50 points against us and the implied volatility coming down. So the downside to this trade is any drop in the implied volatility is pretty much so going to work against the price moving up. And if we go back and look at this again and see what happens if the price moves up instead of down, even with a drop in the implied volatility, what happens? This thing still loses money. So even with a 50-point move up, this thing loses money. Let's go to 100 points. We can see we make about $3 to $4 on this trade if the stock moves up 100 points, but the implied volatility moves down. This is a cat and mouse game. The implied volatility is likely to move down on this trade. The only scenario in which it won't is if the thing explodes higher like it has the past few days and moves 15 or 20%. Then the implied volatility is probably going to get jacked up. And let's look at what that looks like. So instead of minus 20%, let's go plus 20%. And what does that look like? We can see that now we get a double. So the important thing to keep in mind here is the implied volatility. If you believe Tesla is going to rip higher in the next few days, then this is the way to play it. You want to buy a deep out of the money call. You want to pay attention to the implied volatility because it's going to skyrocket back up if this thing rips higher. And let's say this thing does go back to 1,000. So let's add 250 here. And what does that look like? We can see now we get essentially a 4 times move in that option price if this happens to skyrocket back up very quickly in the next few days. So if that is your belief, if you believe in the next couple of days that this thing is going to blast through 1,000, then this is probably a decent option for you to play with. If you don't believe that's the case, and you believe it is going to blast through 1,000, but it might be another month or two before it gets there, let's look at a different trade, which is a trade Mike and I call the cover your ass trade. And for that, we're going to, again, go out to May because we don't know when it's going to blast higher, just it's our belief that it's going to. And for this trade, this is a trade that we typically use to cover our ass on long positions. If the market tanks, this trade does very well because it benefits from implied volatility spiking. And if this thing does continue to rip higher, that will probably be the case. And let's look at that now. So for this trade, we're going to start with a butterfly and then put a little bit of a dazzle on it and put a little bit of our Red Pill Quant's secret sauce on it. So to start with, we're going to do a butterfly and we're going to start with the 910 May, and we are going to sell a butterfly. Going to sell the 910, and then we're going to buy the, go with the 1110. And then we are going to sell the 1210. And let's change this down to one leg. So we have a credit of 23.22, except now we're going to put our secret sauce on this trade and change this to a custom. And we're going to make this a fat-bodied butterfly or a cover your ass trade. And why we call this a cover your ass trade, you will see in a minute. So this trade is going to cost us $16.85 per leg, or that's $1,685 per leg in dollars. And to see what this trade looks like, let's click on Analyze Trade and look at it in the Analyze tab. So this trade costs roughly $1,700 to put on, and why I would play this trade is because typically I'm not in the one-to-one game. I'm not looking to risk one to make one. I'm looking to risk one to make at least two, usually much more. And that's what this trade gives us. We can see, in this case, if Tesla blasts back through 1,000, depending on when it does, let's change this to date, step, 4 steps, and let's go 10 days, let's go 15 days. We can see that even if this happens in the next month, if this thing blasts through 1,000, that gives us a $3,500 profit on this trade with $1,600 risked. That's more than twofold return on our trade. But the important thing about this trade is the margin requirements on it are huge. You can see we're going to need to post roughly 20 grand for this trade per contract. And the benefit of this type of trade is we do not have to time it. This gives us a 6-week window roughly for this thing to pop. Each of these lines here represent different time frames. The first line, this purple one here, is today, February 6th. The blue line is February 21st. This kind of peach colored line is March 7th. The gray line is March 22nd. So we can see what happens is as we go out in time from today to March, our profit shrinks on this trade. So the faster it moves higher, the better. And we can see pretty much so around the end of March, this thing kind of just breaks even if it hits 1,000. However, the next thing we need to look at is what happens to this trade if the implied volatility drops and if it rises. And for that, we're going to go over to the volatility step in the modeler, and we can see what happens. We can see this is, if it rises, that's 40% over what it is now. This is where we're starting. This is where we're up 10%, up 20%. So the reality is if this thing blasts higher quick, not only is the stock price going to move higher, but the implied volatility is going to rocket higher again. And just a quick refresher on what I'm talking about is if we go over to the chart, this line here is the implied volatility. And when this jacks higher, it also jacks up the price of options regardless of what the price does. It makes options more expensive across the board. So if this thing rockets higher again and the implied volatility rockets higher, it's going to benefit us. And this is how we are benefited. Each of these is a 10% step. We can see in the last couple of days, it came down 20% since it skyrocketed a few days ago. And best case scenario, it might shoot up 20% again. And we can see that does our trade quite well. If we move from the current implied volatility and we hit 1,000, that would be roughly a $6,000 profit on this trade. And if the implied volatility gets jacked up, that almost doubles our profit on this trade. So this is a $1,600 trade that could be a $12,000 profit. That's more than 5 times what we have into it, actually almost 6. And that's the way to play it if you are a bull on Tesla and you think this thing's going to rocket higher in the next 6 weeks. However, on the flip side, let's look at what happens if the implied volatility actually comes in. And we can see that it does not do us a whole lot of good. If we start here and the implied volatility comes in by 10 points, that brings us back down to here. You can see that takes a lot of wind out of our sails. If we look at exactly how much, if we go to 1,000, you can see if the implied volatility stays where it is, it's roughly a $7,000 trade. Excuse me, it's $7,000 profit. If the implied volatility comes in by 10 points, that drops our profit down to $4,500 per contract, per leg. And if it comes in 20%, that drops our profit down to a little over $2,000. So we still have more than a 100% return on our $1,700 trade. However, Where this thing starts to really suck is if it just sits still, doesn't do anything, and then slowly just grinds away. And we can see in that scenario, we can actually lose more than we posted for the trade, the 1700, and it just slowly burns away. So in this case, you probably want to be out of this trade if the value of the spread drops below 1700. I would hit the exits, get out, see you, move on to the next one. So if I was a bull and I had 6 weeks to wait, that's how I would play this side of the coin. Now let's look at the bearish case. Let's say we are bears on Tesla. How might we play that? Now let's have a gander at the bearish scenario. If you are bearish on Tesla and you think this thing is going to come crashing back down, probably the case I would put together is that it's probably going to crash back through 600. And let's look at some trades that work like that. If we go back over to the trade tab and let's clear this one out. Again, let's give ourselves some time and go out to May. And let's look at the 600 out of the money puts. This guy here, if we go with a single, let's start by resetting our parameters here. All right, so we can see the $600 put currently has a midpoint of 58.95. And let's say we just buy that. And let's look at what that would look like in the modeler. Right click on Analyze Trade, and now we can see what this looks like. So let's start with our time scenario and see how this thing decays away with time. We can see in order for this trade to be profitable in the next 6 weeks, that is the gray line right here. This thing has to move to at least 651, which is roughly a 90-point move from where it is now. The faster it moves, the better. We can see that if it happens quicker, this thing blows up quicker. And really, for us to get more than a 1-to-1 risk to reward ratio on this thing, we're looking at pretty much so no scenario where it moves to 600 does this thing make more than a 100% return on our risk. This is a $5,100 option. It's a $51 option. One contract will cost us $5,100. And it kind of sucks. As I stated before, we're not really in the 1-to-1 game. I'm looking for at least a 2-to-1 return on risk, and this definitely does not meet those requirements. And even worse, what's likely to happen when this thing comes crashing back down is the implied volatility is going to drop as well. And let's look at what happens when that happens. Safely, we need to probably plan on a 20% drop, 20-point drop in the implied volatility if this thing moves to 600. And we can see that even with a 150-point drop, even if it happens like tomorrow, we still don't get more than 100% return on our risk. It's less than a 1-to-1 return. And even if it happens next week, we can see it's already around 80% return, which for an options trade pretty much so sucks. None of these are really good scenarios, and the difficult part with any options trade on the bear side in Tesla right now is that the implied volatility is going to come back down and pretty much so crush any type of trade that we put on. Let's look at that from doing the same type of trade we did on the bull side, which was the cover our ass trade, the CYI trade. Let's look at that on the bear side so you can see what I mean. So let's go to Delta Gamma Theta Vega. And for this scenario, we are going to buy we're going to start with a butterfly trade. And let's go with the 715, sell butterfly. So we're going to sell the 715, and then we're going to buy, let's go with the 620. So 620. And then we're going to sell the 580. And let's change this back to one contract. And now we put our twist on it and make it a fat-bodied butterfly. And this is a trade that is not cheap. It's going to cost us $25.83 per leg, or that's $2,500 per leg. This is also a very expensive trade because Tesla is a very expensive stock numerically. And now let's analyze this and see what this looks like. We can see that let's get rid of that. For our $2,500 risk, or I should say price of admission on this trade, it needs to move to 593 if the implied volatility comes in by 30 points. If it comes in by 20 points, which is very likely the scenario, the break even on this trade is 630, which kind of sucks. If it does go to 600, we're looking at roughly a $700 profit on this thing, which sucks considering we're risking at least $2,500 on this trade. So there really is no good scenario on the bear side unless this thing completely tanks and moves way through 500 through 450. You can see where this trade gets a 2-to-1 return. We basically need to move through at least 550 or so. And if you think that's going to happen, by all means, this is the trade you probably want to put on. You've got quite a bit of time for it to work. If we change over to the day step and look at how this thing does at different scenarios, if we go out to March 22nd, that's as long as you probably want to hang out in this trade. We can see that our break-even point is roughly 630. At 600, this thing is still only looking at like a $700 profit. So for any bearish trade in Tesla right now, you've got to be a super bear and hope this thing takes a massive ass pounding and moves well through 500 to at least get a 2-to-1 return on your investment, on your risk. And you can see this trade starts to burn away pretty quickly as we get out into April. So that's why I would be out of this no later than the 22nd of March. And the other thing to keep in mind here is just like our cover your ass bear trade, or excuse me, bull trade, the margin requirement on this thing is insane. We're looking at posting almost 10 grand in margin for a $2,500 trade. So realistically, to put a trade on like this with proper risk management, you probably need at least $150,000 account, probably closer to 250 or 300 to properly size this. So again, this is a big boy trade, and I would not recommend this unless you have an account that is at least that large. So that is the bearish case. In summary, there really is no good way to play this from the bear side unless you think this thing is going to get hit by a rocket and tank back down to well through 500. Then by all means, go for it. Finally, the last trade I want to talk about is the professional trade. Why I call this the professional trade is really when it comes down to trading options, I'm not in the game of guessing direction. Long term, stocks tend to go up, but trying to be a guru and have a crystal ball and know exactly what they're going to do in the short term is not the game that I play. I can show you how I would play this. I'm really not in the game of playing direction. I am in the game of mean reversion. And what is likely going to happen at some point is this implied volatility is going to come crashing back down to earth once the price of the stock stabilizes. If we look at what the current options are going for, today is Thursday, the 6th, and the options that expire tomorrow, we can see the at the money. Let's go to 14, the at the money options. Even the ones that expire tomorrow are going out for roughly 19 bucks for the at the monies. Crazy. If we go out to, let's say even the middle of March, roughly a month, or the beginning of March, let's say March 6th, you're looking at 80 bucks on both sides of this thing. Unfortunately, I think the train has probably already left the station, unless you really go out in time. Let's go out to April. We're looking at the monthly expiration Aprils. We can see these things are going for roughly 100 bucks for the at the monies. So the professional trade here is to play the implied volatility. And how that works is you would short the straddle. You would sell this option and sell this option, and then you would delta hedge to counteract the price movement as this thing moves around. And if you do this correctly, this is going to be a very profitable trade. Why I say this is the professional trade, again, for two reasons. One, that you're probably not going to be shorting options with a $750 strike price with a 83% implied volatility in a retail account. And you will also probably need at least a seven-figure account to properly put a trade like this on, even for one leg on each side. And delta hedging is a bit complicated. The concept is not so complicated, but the execution of it on the retail front is quite difficult. You can have all kinds of problems. For example, if Tesla went hard to borrow and you needed to short stock to maintain the correct hedge with this thing, that would get very difficult. You could do it by buying options, but again, it's a complicated trade and not recommended for retail traders because the reality is you probably can't do it anyway, unless you have a massive account. unless you're trading with a 7-figure account. Then you could probably do it. And then I still wouldn't recommend it unless you're pretty sophisticated, know your math, you've backtested this, you can code in Python or C++, and you can automate the delta hedging aspect of it. And then you could do quite well. And to give you an example of what that trade would look like, if we were to short the at-the-money strikes right now, this thing is right around 745, so we're going to short the 745 call and short the 745 puts. Let's go back to the Theo price so we can see. Roughly, this is 106 bucks on this side and 99 bucks on this side. And now let's look what happens to these prices with a 20% drop in implied volatility. We just go over here and change the implied volatility by take 20 handles off of it. What does that look like? We can see that on the put side, we pick up about 25 bucks in profit per contract and roughly about the same on the call side. So we short these for roughly 200 bucks for the pair and a 20% drop in implied volatility, and we can buy these things back for roughly 150 bucks for a quick profit, because the implied volatility in this thing is probably going to come in within the next few days. And if we are properly delta hedged, this would be a very profitable trade. However, I really feel like the train has left the station on this one. The time to do it was 2 days ago when the implied volatility was 120%. Rest assured, if that's where it heads back to, that's probably where the professionals will be running back into the pool and putting a trade like this on. Because we don't know if it's going to go higher or the stock is going to go lower, but we do know that the implied volatility will go lower without a doubt. In summary, here's what we're looking at in Tesla. If you are a super bull, just buy the 1000 call and hope this thing rockets through 950 and 1000 in the next couple of days. If you're just a bull and you believe it's going to grind back through 1000 eventually, sometime within the next 6 weeks, I would do the cover your ass trade, the 910, 1110, 1210 call sets. Going to sell 1, buy 3, sell 1. If you are a bear, sorry, nothing for you. Not even a sucker. Bears are going to have to sit on the sidelines for the moment if that's your stance. If you are a super bear and you believe this thing is going down in flames through 500, then you want to use the cover your ass trade with a put setup using a 715, 620, 580 put set. You're going to sell 1 715, you're going to buy 3 620s, and you're going to sell 1 580. And the pro trade, which has no particular view on being a bull or being a bear, would be to short the straddle and delta hedge as the price moves around. And that is our take on Tesla for February 6th, 2020. Enjoy.